Jay Powell's leaning more towards 25, so obviously huge relief in markets. But I wonder for how long, with oil at 114, approaching early Asia Thursday, 115 on Brent. I mean, as a net energy and oil importer, Asia's got to be concerned.
Yeah, the big shift in markets and economies at the moment, of course, is the strength of these Western sanctions. And they keep pushing the boundaries of what we thought that the G7, EU and the allies would be able to hold together. Firstly, of course, the sanctioning of the Russian central bank's FX reserves. That left the last kind of support system for the Russian economy being those gas exports. That's now looking under pressure, and that would definitely change the global macro picture if that occurred. We have seen an increase in energy prices, of course, as your reporting has been going over this morning. And the big impact on Asia for this is, of course, in the energy-hungry importers, Japan, South Korea, China, and India, of the biggest energy importers in the world. So we can expect to see a bit of downward pressure on those currencies as their energy bills start to mount. And then we also could see some other impacts around the region. Russia is an important supplier, for example, of metals to manufacturing in the Philippines.
Simon, from a headline growth point of view and inflation expectations point of view, then, when you throw it all together, do we upgrade Malaysia, Indonesia? Do we downgrade China and India, South Korea, the net importers and exporters? How do you approach the re-rating process?
Yeah, we at the EIU have raised our commodity price forecasts for a number of commodities for the rest of the year. Of course, the energy commodities are now higher than they were. Although it's interesting to note the increase has been about 10 to 15% so far on the pre-Ukraine invasion numbers. Energy was already higher before that because of the rising geopolitical concerns. So a lot of that had been priced in. But the additional disruption that we're now expected to see is in some metals and also wheat. Those prices will be higher towards the end of the year. So I think the run down in inflation in Q4 this year that we were expecting to see, say a month or so ago, that's probably now going to be delayed. So the higher prices and the inflation will last a bit longer than expected. What does that mean for the Fed? I mean, of course, these price increases are not a demand issue, and it's not because of, say, overheating in the US economy. So it's not clear that the Fed will necessarily want to turn up its interest rate increases because of that. So I think the Fed will stick to its current path for now. So my expectation is the same.